1980, when gold was in favor, gold had an 8% market share. What I'm interested in is, even if gold didn't come close to capturing its former market share, if there was a reversion to the 40-year mean, my suspicion is that gold demand would be substantially higher than it is today, too. Note something else. The market share of central banks' holdings of gold had fallen substantially. So there's competition for gold in the market now. To the extent that the retail buyer, the private buyer, comes into the gold market, there is still substantial central bank buying.
Gold's macro story right now is inseparable from the US dollar and global risk sentiment. The DXY has been swinging as traders constantly reprice expectations for growth, inflation, and the Fed path. A resilient US economy with sticky inflation can keep the dollar elevated, capping gold's upside. But any signs of slowdown, financial stress, or a pivot toward easier policy can flip that script. RickRule explains that U.S. fiscal deterioration had been building for years without a market reaction because investors were anchored to past crises like 2008. In his view, gold's breakout was driven less by American inflation fears and more by foreign central banks being pushed to diversify away from the U.S. dollar and into gold. RickRule mentions the broad retail investor, what he calls the natural buyer, is still largely missing from the gold trade. While dedicated precious metals followers are active, overall portfolio allocations remain historically low. Citing data from the World Gold Council, he mentions that gold's share of global investment assets is still far below levels seen in 1980. He also emphasizes that strong central bank buying continues to compete with private investors for limited supply, reinforcing long-term support. Adding to this backdrop, recent industry reports show central banks extending multi-year buying streaks into 2026, while gold-backed ETFs have begun seeing renewed inflows after prior outflows, a shift that signals institutional and retail participation may be gradually re-entering the market. Moving forward, Rick predicts that mining stocks could still re-rate higher because many Wall Street valuations are based on much lower metal price assumptions. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from RickRule's recent interview.
I think the move that we saw last year is important to put in context too, Donegan. I think the move that we saw last year was rear-looking, not forward-looking, in the sense that everything that was true at the beginning of 2025 with regards to the deteriorating fiscal condition of Western governments, but especially the U.S. government, was true in 2017 and true in 2018. But there was no price response. People looked at the circumstance through the lens of experience that went back to 2082. In other words, people were rear-looking rather than forward-looking. And so tension built up in the gold price for a very long time. The circumstance continued, it got worse, it continued, it got worse, it continued, it got worse. Nothing happened. And even when it moved, it didn't move because Americans were concerned about the deterioration in the purchasing price of the U.S. dollar. It moved because the U.S. government gave foreign central banks no choice but to save in gold away from the U.S. dollar. What that tells me is that the real natural buyer for gold mostly isn't in the trade yet. I mean, yes, the people who were clients of mine before I ostensibly retired, and the people who are listeners to you, our crew, are excited by what's happening in gold, and they believe in gold. But you live in Florida. It's like if you went to a rural Pentecostal church in Florida and asked the choir if they believe in God. You're going to get an affirmative response. But most people aren't in the gold trade yet, which tells me that gold has further to go. Now, it may be that the adherents, it may be that choir's out of breath, and there's no move in the gold price for 2026. But the whole set of circumstances that propelled gold is very much intact. So the trade is very much intact. What's important to note is the second part of your question, I think, for those of us who care about the trade, which is to say that if the gold price doesn't go up from here, or the silver price doesn't go up from here for a year, there's still room to run the stocks, because Wall Street's calculation and Bay Street's calculation on the value of these companies is predicated on $3,500 gold and $45 silver. Now, if your earnings estimates are based on $3,500 and you're selling the gold for $5,000, it's kind of hard not to get a surprise. And if you redo your net present value calculations or future cash flows at $5,000, up from 33, 34, 35, you're going to have some positive surprises. Same thing in the silver market. When I look at the Bay Street earnings forecasts and the Wall Street earnings forecasts, they're using $45 silver. If you revalue these things at, say, silver price, you get a much higher number. So I suspect, particularly with regards to the senior silver producers, that if I see a sideways movement in silver for 12 months, I see stocks that have 50% to run on a valuation basis alone. Pretty attractive. I'm not saying that's going to happen because sometimes narrative trails arithmetic, but I'm an investor that's all about arithmetic. So I'm feeling fairly sanguine about things. First of all, and most importantly, this is global. Point in time when I described gold as comprising 0.5% of Americans' holdings, it comprised 1% or twice as much of foreign holdings. What's happened since is that mostly foreign currencies have declined relative to the dollar. So the gold price has gone up in dollar terms, and the dollar has gone up in rupiah and renminbi and yen and euro terms. So the gold has revalued in the foreigners' accounts, and they already had a higher percentage, a higher market share in gold than we did. And this chart demonstrates it. Gold continues to be substantially underowned. What's interesting about this chart is where you would call reversion to mean. If you look at 1980, when gold was in favor, gold had an 8% market share. What I'm interested in is even if gold didn't come close to capturing its former market share, if there was a reversion to the 40-year mean, my suspicion is that gold demand would be substantially higher than it is today, too. Note something else. The market share of central banks' holdings of gold had fallen substantially. So there's competition for gold in the market now. To the extent that the retail buyer, the private buyer, comes into the gold market, there is still substantial central bank buying. So there's two classifications of buyer now. All of that's bullish. Investor behavior, however, which is sort of what that chart is about, isn't as important to me because in the near term it's shaped by narrative than investor motivation. Investor motivation, I think, will be shaped by the deterioration of purchasing power in fiat currency denominated instruments. I think that's really important. In other words, the narrative will follow the incentive. And the incentives, debt and deficits, quantitative easing, unfunded entitlement promises, the slow realization that people have that their savings and salaries are not keeping pace with the deterioration of the US dollar and that they need to change their savings matrix to protect their capital. I laugh. It's tragic for most people, but that's going to have dramatic impact. You know, when I say, I need to be better about how I communicate this. When I say in the abstract that I believe the purchasing power of the US dollar declines by 75%, people nod sagely and then, go on about their day. What I need to say is that a pensioner who is living today on $4,000 a month will require $16,000 a month to maintain the same standard of living 10 years from now. And where will that extra $12,000 come from? When people personalize it like that, when people understand that if they're getting paid 4% on their savings in a currency where the purchasing power is declining by 4% a year, what's happening is they're losing half their savings rather than making 4%. People need to personalize this. Whether or not they buy gold is of less interest to me, frankly, than whether they understand that they are responsible for their future and their children's future. Their community isn't, their government isn't.
Most investors are waiting for the next gold rally. RickRule says it's just hidden inside the balance sheets of companies Wall Street hasn't bothered to recalculate yet. He argues that if producers are selling gold closer to $5,000, earnings and valuation models are likely understating reality. As a result, he believes even a sideways gold market could lead to meaningful revaluation in quality mining stocks due to inevitable positive surprises. However, Rick also reveals that he recently sold 80% of his physical silver. He explains that silver was a speculation in his portfolio, not a savings asset like gold. Having watched the hated trade thesis play out as silver rose several-fold, he believes the physical metal has done its job. Now, the real opportunity has shifted to silver mining stocks. He adds that part of the proceeds were shifted into physical gold, considering them as long-term savings and capital preservation, distinct from speculative positions. Let's jump into the interview.
Well, I believe, just because I read the analyst reports, that the analyst reports, both in terms of their earnings forecasts and the net present value calculations, are predicated on sharply lower precious metals prices. If the precious metals prices trade sideways for a year, it would suggest that valuations can move higher. The consensus metals prices on Wall Street and Bay Street around gold seem to cluster in the $3,200 to $3,500 an ounce range. Now, it seems to me if you make the stuff for if you sell the stuff for $5,000 and your earnings forecast is based on $3,500, that arithmetically you're pretty likely to surprise folks, and the surprise is likely to be good. Similarly, if you're doing a net asset value calculation of future cash flows and discounting them back at Wall Street's prevailing 5% discount rate, and you're using a $3,500 denominator, which is to say a $3,500 gold price in a $5,000 world, that you are understating the value of that company fairly substantially. If the gold price doesn't fall fairly substantially, it would seem to me that the good guys, the real producers, revalue very, very substantially just to reflect the current reality of this gold and silver price, not to anticipate higher prices. I was fairly public a few weeks ago about selling 80% of my physical silver. I did it for two reasons. I did it because silver occupied a speculative position in my portfolio. Gold for me is a savings asset. Silver was a speculation. I bought silver because it was hated. You'll recall, Dunnigan, in our earlier interviews, when I described silver as a coiled spring, that when the hate dissipated, it would be easy for the price to double. Well, it didn't double. It went up fivefold, sixfold. When that happened, the reason that I owned my silver went away. I owned it as a speculation. And I had to decide, was it still the best speculation in my portfolio relative to the amount of capital I had tied up, or was there something better to do with it? And I decided for half the money that was in my silver portfolio that I'd rather buy the silver stocks. Because if silver didn't go up anymore, by definition, I couldn't make any money. If silver did go up, the silver stocks would go up too. But if silver just went sideways, the silver stocks would go up by 50%. That seemed like a better speculation to me. For me, it's all about arithmetic. Ironically, if the price of silver fell, while the price of the silver stocks would fall, the values wouldn't need to fall very much because the net present value assumptions were made at a $45 silver price. So if the price of silver fell from 80 to 50, that's still above the consensus silver price that people have used to calculate those net present values. So it seemed to me like I had a better speculation in the silver stocks than the silver. Now, for me, gold is a very different circumstance. I save in gold. So 25% of the capital that I drew out of the sale of 80% of my physical silver went into physical gold because I wanted to take some of my speculative gains all the way off the table and get them out of harm's way. And as you know, Dunnigan, since the year 2000, I've maintained liquidity in US dollars, but I've saved in gold. I regard them personally for myself as very different assets or asset classes. I don't know how your customers feel about it, but that's how I feel about it. I suspect over time that metals are fungible, which is to say, if one market finds a way to have a real plurality over another market, that the metal will chase the money. I'm reminded years ago when the Indian government put a big excise tax on physical gold and silver. And I talked to some Indian friends of mine who are, well, I would call them traders. The Indian government would call them smugglers. About the impact of the excise tax. And they said, well, we hope they increase it. And I said, well, how does that work? They said, well, it costs us 2.5% to get gold from Dubai to India, and we sell it without the tax. The government has basically built in a 12.5% margin for us. That tells us that over time, disparities in markets are solved by informal means, not in the near term, but in the longer term. I would note, too, that the recently publicized pronouncement by the Chinese government that they were going to limit the exports of silver to their licensees was less about limiting silver and much more about rewarding their friends. They immediately awarded 42 export quotas to people who I suggest were probably fairly close to the regime. It's important that you understand their news in context.
Gold bugs argue that decades of monetary expansion, relentless debt growth, and recurring crises make a strong long-run case for higher gold prices. They see every corrective wave as a buy-the-dip gift. If gold remains near current levels and central bank demand continues, will mainstream investors finally step in and reprice metals, or will Wall Street remain anchored to outdated assumptions until the next major breakout forces a reassessment? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.